Hi, welcome to another interesting section with the portfolio. So, today I want to teach you how to analyze and invest in insurance stocks. Now, note my caption. I said how to analyze and invest. I did not say how to analyze and trade. They are two different things entirely. So, which means that I'm actually dedicating this video to people that want to invest in insurance, meaning that they want to put their money in an insurance stock that they think will do well in the next 1 to 3 years. So these are long-term investors. Then for people that are also looking at how to trade profitable insurance stocks, you can trade insurance stocks. You can also trade profitable insurance stocks. They are two different things entirely. Now, for an insurance company to be profitable, it's not exactly what you think. So it's funny how I read when I read analysis of insurance companies online and how that people tend to get it wrong and how they present information in a way that does not actually portray the true nature of that insurance company. Now, when you read a website like ProShare or other business websites, when an insurance company releases its financial statement, you know what they focus on? They'll tell you the insurance company and this amount as revenue, and the next thing will go down to say profit after tax, profit before tax, profit after tax, net asset, and that's all. So, because an insurance company is growing its profit after tax, does that actually mean that the company is profitable? So, there are things you need to watch out for. There are things you need to look at, and that's what I'm going to share with you. Insurance business is not the same as a product-based business, and it's not also the same as a bank. So, the way you analyze these three sectors should be different. So, in the market, we have product-based company or service-based company. So I will classify them under retail-based company. Do you get it? Then we have the financial service company. Then we have where insurance falls under. So you need to be very, very careful when you are analyzing stocks like insurance. Do you get it? You need to be very, very careful. Now, when I'm analyzing a retail-based company, before I go down, or if I rush down to profit after tax, I want to see that the company is actually profitable in its core business. Now, what I mean by core business, I want to be sure that the company is actually profitable in that business that it's doing. We call it operating activity. So, if a business is telling me that they sell laptop and tomorrow they declare a profit of 10 billion, I really want to be sure that the majority of that profit is coming from that business of laptop. Because this company that is selling laptop might be generating loss, might actually be incurring loss at that operating level, but maybe because of one extraordinary activities, maybe they got involved in sales of furniture, disposal of their fixed assets, and that brought in a lot of money, and eventually their profit after tax went up. So if you're not careful, you will end up investing in a bad company. You end up investing in a loss-making company. So a positive figure at the bottom level, which is profit after tax, does not automatically means that a company is profitable. So that's what I want to establish, and I'm going to teach you how that works in insurance. Now, in subsequent videos, I will be showing you how to analyze banking stocks. So, but let's start with insurance. The business of insurance is not as um, straightforward as you think. Do you get it? So you don't use the model or the model that you use to analyze your retail-based companies to also analyze an insurance company. Insurance company is completely different. So in this video, I'm going to teach you how to really analyze an insurance stock and what you need to watch out for. Now, apart from the normal metrics that you have or that you know, which I'm not against, which I like very well, but I'm going to show you the three most important metrics you need to analyze an insurance stock. In short, if you're going to be comparing two insurance companies together, these are the metrics you should be watching. These are the metrics you should be looking at, and not profit after tax. Yes, net asset is fine. um, I don't know. I'm just trying not to spend my time in this introductory part of the video. So you need to be specific. What are the three most important things you need to analyze an insurance stock? So when you're comparing two insurance companies, these three key things are exactly what you need to know whether this company is better than the other, whether it's far cheaper than the other. And then even if you're looking at the industry average, it's still the same benchmark that you're going to use to check for companies that are profitable or not. Now, it doesn't mean that these three metrics are perfect. You can extend your analysis to other metrics, but these are the three most important things I watch out for if I'm going to be investing in an insurance company. So let's discuss the key terms that you need to know before we discuss the three metrics. Now, the key terms you need to know in an insurance business, we have the gross premium, we have the unearned and earned premium, we have reinsurance, we have net premium, we have claim, and also underwriting. So you need to understand this. These are the things you need to know when a business is into insurance. You first need to be sure that that insurance business itself is profitable. That's one thing. How does insurance generate revenue? There are two ways insurance generates revenue. There are two ways insurance really make money. First, insurance makes money from premium collection. That's the first one. The second one is they make money from investments. That means the premium they collect from their clients or policyholders, they invest it in other assets, mostly fixed income, risk-free assets. So even if they want to invest in equities, I'm not sure a larger chunk of that premium will be assigned to equity markets. So we'll classify whether it's fixed or equities, we'll classify them under investment income. So we're looking at two ways to generate money. The first one is premium, the second one investment income. Now, if I am going to be analyzing an insurance stock, the first thing I want to be sure of is whether the business of insurance itself is profitable. So whether it's in life insurance, general insurance, whatever type of insurance the company is doing, they all come under the same insurance business. What does insurance do? They collect premium. Do you understand? They collect premium for offering to take you back to that state that you were before the risk. So whatever risk you actually covering. So that is. I don't want to go into details of what an insurance is, which I know you already understand. But I'm trying to understand. I'm trying to share the key terms you need to analyze an insurance stock. So now, when they collect this premium, what happened? That's another thing you need to ask yourself. Remember, we are looking at the business of insurance itself. Are they actually profitable? Because the profit after tax you're seeing at the bottom is made up of so many things. One, is driven by premium, number one. Number two is driven by investment income. Number three, it could be driven by exchange rate gain or loss. Number four, it could be driven by operating activities. So you need to be sure that the first business itself, which is insurance, is actually profitable. Because it's possible that an insurance company could be losing out in its core business, but using other revenue sources to patch up. And then you eventually see profit after tax 10 billion, and you're excited. Oh, 10 billion as against 5 billion last year. And you say, oh, 100% increase. But when you now check the business of insurance itself, they're actually making loss. They're actually making loss. Now, the loss here is not the operating profit. I'm going to show you how to check if an insurance company is really profitable or not. The same way you check earnings before interest and tax, earnings from operating activities, operating earnings. I'm going to show you how it works in the insurance sector. So, but before you understand that, let's look at each of these key terms. Now we have gross premium. What's gross premium? Gross premium is the total premium collected. The total premium collected from the policyholder. That's gross premium. Total premium collected. Now, in this premium that is running, there are some that are earned and there are some that are unearned. Now, what do you mean by earned and unearned? Now, I undertook an insurance policy to cover my car, and it's going to run from January to December, right? Now, and I paid 100,000 naira. Hmm? Sorry, let's say 120,000 naira. So that's like 10,000 per month. For 12 months, 120,000 naira. Now, The gross premium is 120,000, which is what I pay. Now, if I've used 3 months, 3 months is gone. Hmm? Out of that gross premium, the 3 months that is gone already is earned premium. So if an insurance company is to record it in their book, they are going to post gross premium 120,000 naira. Unearned premium will be 70,000 naira, which is the part of the premium that is yet to be earned. Why? Because the period the policy covers is yet to elapse. So the end part of that premium is 30,000 naira because 3 months is already gone. So end premium is that portion of the gross premium that their policy that the period covered has elapsed. So that I don't work in the insurance sector. So I'm trying to be just break this down for layman to understand. Now we then have reinsurance. So most of these insurance company, they also partner with other bigger insurance company to help them cut the risk, to help them undertake policy covers, and then to also how do I explain this now? Um, like having an insurance company to come to your aid, do you understand, in case the risk is higher than what you can cover. You get it? So some of them they also undertake another insurance with a bigger company. So that's like reinsurance. So yeah, now and they pay the insurance company a certain amount of money for that. So when you collect money from your clients, you also go to pay a certain amount of money to another insurance company. Most times it's always bigger to undertake to also help you cover the risk. So in case the risk is kind of bigger, that other insurance company can also assist. Now the costs of doing that we call insurance expenses. So out of the premium that you've collected, which is this end premium, by the time you deduct your reinsurance expenses, you're now going to have what we call net premium. Net premium. So 30,000 from 120,000, it's my end premium because the period is has elapsed. Then out of the 30,000, I could say, oh, let me give 5,000 to another bigger insurance company to support this policy. Then 30,000 minus 5,000 becomes 25,000. So that 25,000 is what I call net premium. Net premium. So here we collected the total insurance of 120, and then the end premium from here is on end premium is 70,000. 120 out of 30, that's like 90,000. Then the on the end is 30,000. So I then paid 5,000 to another insurance company. So my net premium will be 30,000 minus 5,000, so which will give me 25,000. So which will give me 25,000 naira. Now can you see? So my net premium is 25,000 naira. Now of all this premium that you have here, which is the most important when you are analyzing an insurance company? Can you see that we have different premium? Gross premium, end premium, unearned premium, net premium. So if you only look for premium, at the end of the day, you might not really get it right. So you need to break in the premium itself. There is still the main one that is more important. So of all this premium, the most important of all that you need to analyze an insurance company is net premium. Net. This is what the insurance company this is what they have right now. This is what they have out of the one that's earned. This is what they have. Now, this 90,000 remains unearned until 1 year is covered. So at the end of the year, this 120 that is gross becomes end because the 12 months is gone. So or 12 months has elapsed. So by then we'll say our end premium will now be 90,000 naira. So whatever amount they pay as reinsurance expenses, then the balance will be net premium. So net premium is what the insurance company has. This is their own money. So if at the end of 12 months nothing happened, this is like free money to these guys. So net premium is like the free money they get. So when you calculate all the premium that the insurance company collects, focus on the net premium. Which of them is the net premium? Because that's their own money. That's their own money. Assuming that all the insurance policies that they are covering elapsed. Do you understand? What is how much is their own money? Is the net premium. Is the net premium. That's assuming nothing happens. Now, if something now happens, that's where we're now drilling down to the business of insurance itself. If something happens, what happened? They're expected to compensate the client or the policy holder. So that is where claim comes in. Claim comes in. Claim is the total amount that they pay to clients or to their customers or whatever name you feel is right to compensate them for the loss incurred. That is claim. Then we have what we call underwriting expenses. So we have underwriting. So what's underwriting? Underwriting is the process an insurance company undertakes to ascertain whether your business is worth their time, whether your business can be acceptable. So they are going to analyze your company. They're going to do a lot of analysis. Let's see if your business, what are you into? So all the amount incurred in this process up to the expenses. That's that's what we call underwriting. So we call it underwriting expenses. So if I want to be specific, call it underwriting expenses. Then you can come here to say claim expenses. So in the business of insurance, when losses arise, what happens? They are expected to compensate the client for the loss incurred. They're supposed to compensate the client to see how they can take the client back to the position that the client was before the event. Now, how much they are going to pay will depend on the premium that the client is paying. So that's why when you are undertaking an insurance policy, ahead of time, they would have shown you how much they're going to pay you if this happened, if this happened, if this happened, if this happened. Do you understand? Now, when you're now analyzing an insurance company, the best thing to do is you look at how much they collected as premium, which is their own money. Now, from this premium, how much did they pay as claim expenses? So if an insurance company paid 40,000 as claim expenses, let me say 30,000 as claim expenses. So we have scenario one. Scenario one is that the company paid 30,000 as claim expenses, and scenario two is that the company paid 5,000 as claim expenses. I'm going to explain this later. Scenario the second one, scenario one, the company paid 4,000 as underwriting. That's in the process of ascertaining the business of insurance, whether your business is what their time, everything that they require to cover you under underwriting. So and then scenario two is that they paid 10,000 as underwriting. So let's now analyze this scenario. So this is where you know whether an insurance company is profitable or not. Remember, I have not talked about profit after tax. You've not seen me mention profit after tax, operating earnings. We are analyzing the business itself. Is it worth it? Some insurance company are actually loss-making company, but they only use extra ordinary activities to cover up. Or maybe they have good investment banker. Maybe they just employ a very good investment banker who is able to show up their revenue with investment return, investment income. So and then you see profit after tax blowing up. You have to be very careful. First, be sure that the business of insurance itself is profitable. So that's exactly what I'm showing you. Now, look at this. They collected 25,000. Let's look at scenario one. They collected 25,000 as That's the total net premium after accounting for insurance expenses and then taking the end portion of their gross premium, right? Now, claim expenses. Scenario one, they paid client 30,000 naira. They paid clients 30,000 naira. Total amount paid so far is 30,000 naira, number one. And total underwriting expenses is 4,000 naira. So when you add 30,000 plus 4,000, that will give you what? 34,000. Meaning that in their business of insurance, they've paid out 30,000 as claim, which is nice because they are supposed to. Besides, that's one reason most Nigerians don't undertake insurance. Aside from the fact that they believe nothing will happen, they've known insurance to be one stressful kind of business that if anything happens, it becomes difficult for them to compensate you. So that's why this claim is very, very good. So I'm not against any insurance company paying our claim. But here's my point. The claim expenses here plus the underwriting expenses is what? 34,000. But how much do you have as your free money? Net premium 25,000 naira. So how can you be paying out 34,000 naira when the total free money that you have is 25,000 naira? Meaning that you actually dipping hand into your pocket to take out an extra 9,000 naira. So if you continue to do that, it means the business of insurance itself is not profitable. Close shop. You're not making money. The guys who are estimating this premium, they are not doing their job because it's like the risk involved is higher than the premium you're taking. Because for you to pay out this claim, you must have done your estimates. So why are you paying out more than you collected? So these guys that are in charge of calculating this premium, they are not doing their job. They're supposed to have estimated an amount that you can actually pay out from and still have extra. So claim expenses is very, very important. So by default, a company should not be paying out more than what it has collected as claim. Now, I'm not saying that the company is not supposed to be paying out claims, but before you do that, make sure you do your homework. Make sure the premium you are collected can cover up for that risk that you are undertaking. So at the underwriting level, this is where they're supposed to do their job. All the expenses you incur in analyzing that insurance company, looking at the business, the possible risk, what it will cost, and everything that you require to calculate your claim, you ought to have done a good job for you to be in business. So if an insurance company is paying out more than its premium, then there is a problem. Now, scenario two, the company paid out 5,000 naira. Remember, they are still collecting the same premium of 25,000 naira. They paid out 5,000 naira and underwriting expenses is 10,000 naira. What is the total amount? 15,000 naira out of 25,000 naira, meaning that they have 10,000 naira left as extra. This is a good insurance company. That's the type of insurance company you should be investing. You should be investing in a business that is profitable. So if you want to look at how profitable an insurance company is, understand this that I've shared with you right now. Make sure you pay attention to net premium collected, claim and underwriting expenses. Now, when you add claim expenses to the underwriting expenses, it gives you what I call combined ratio. So this is one important metrics you need to analyze an insurance company. What is the combined ratio? So the combined ratio is claim expenses plus underwriting expenses all divided by net premium income, which is this net premium. So if your combined ratio is less than 1, then it's good. But if it's more than 1, then it's bad. So let's look at this again. The company paid out 40,000 as claim. 40,000, 30,000 plus 4 is 34,000. 34,000 divided by 25,000 will give you 1 point something. Is above 1. so it's bad. This 15,000 divided by 25,000, that will give you 0 point something, then it's good. So if combined ratio is less than 1, then it's good. It means that the company is paying out its claim as at when due, but it still has extra. So meaning that the net premium that the company is collecting can actually cover up for the claim, underwriting expenses, and still give them extra money. That's the free money that insurance company is collecting. So when people say the business of insurance is free money, you need to understand where the free money is coming from. So if Warren Buffett is investing in insurance company, he is not just investing because insurance company is collecting free money. No, these are the things he watch out for. These are the things he looks at. So when you're investing in insurance company, don't just focus on gross premium, profit after tax, and nah, you are missing out the core detail. That's why suddenly you just see that an insurance company is no longer operating again. They've closed shop, and you're wondering, oh, they're actually making profits. They made profit of 10 billion last year. What happened? This would have told you. This would have been a sign. Combined ratio would have been a perfect sign, would have given you that signal, because combined ratio above 1 is telling you that this company is actually paying out more than the premium is collected. This company is paying out more. You need to be very careful. So except that you're trading them, then you can probably look at the region is good to buy. But for someone who is going to invest and say, I want to put my money in this company for the next 1 to 3 years, this is the metric you need, because you need to invest in a profitable company. That's where the free money is coming from. It is the free money that is coming in that this insurance company can now, although sometimes you see that claim expenses might be lower in case there is no risk covered for the year, which is also good. So if claim expenses reduces because there's no risk, major risk to cover for the year, combined ratio, what happened to combined ratio? Combined ratio will also go down, because eventually the total claim plus underwriting expenses will be far lower than net premium. And by the time you do the calculation, your combined ratio should be less than 1. So, but that doesn't mean that it's good for an insurance company not to pay its claim expenses. Pay your claim expenses as at when due, but make sure you're not paying more than the net premium income. So, we're going to look at 3 scenarios. We're going to look at 3 companies. We're going to look at how this play will play out. And then, out of these 3 companies, we'll then come up with the best among the 3. Now, it doesn't mean that they are going to appreciate more, but because of for this purpose of this analysis, that's why I had to pick 3 insurance company. I picked NEM, Ico, and AXA Mansard. So we want to compare these 3 key metrics that I'm going to talk about. So the first metrics is combined ratio. So let's move to the next one. So the 3 key metrics that we need to analyze an insurance company are: 1, combined ratio. I already explained combined ratio. Combined ratio is very, very important. Now, if the company is profitable, meaning that if combined ratio is less than 1, then we can then look at return on equity. So the return on equity is their profit after tax divided by shareholders' equity. So if combined ratio is less than 1, then it means that underwriting profits will be high. Then we'll then look at investment income. Investment income is that portion, the portion of that premium that is being invested in other assets, liquid assets. Because if it's time for them to pay back the claim, they have to liquidate some of their investments for them to cover up for that. So that's why I don't really look at investment income. Investment income should be extra, because if the payout claim is from the premium, and if this premium is free, they are going to invest it in treasury bill. That's why they are heavy investors in treasury bill. Most of these commercial paper are fixed income assets. So the next part is investment income. So investment income, you add investment income to your underwriting profit, and then you can come down less your expenses. Then you now begin to look at profit before tax, profit after tax. So 1, profitability in terms of current combined ratio, then return on equity. You are a shareholder in that company, so you need to look at what the return on equity is, profit after tax divided by shareholders' equity. So that is one important area you need to look at. Now, when you're analyzing an insurance from this perspective, don't look at it from a single year. Make sure you do a comparative analysis, at least, or trend analysis, at least 3 years. In the last 3 years, what's the combined ratio? In the last 3 years, what's return on equity? And then the fourth one is the net book value of that insurance company. Because as they are collecting premium, that premium is adding to the asset of that company because the money is going to their bank. That money is being invested in an asset in fixed income securities, and it's also adding to the value of that company. So eventually, you need to look at the total assets against total liabilities. So you need to look at total assets against total liabilities. So then the value that you see after you have taken out all the liabilities from the asset divided by the shareholders' equity, that will give you net book value of that company. That will give you net book value of that company. So let's look at one company. So we're going to look at a company like Name Insurance. So what's the combined ratio of Name Insurance? What's the combined ratio, or what's the return equity on Name Insurance? And then what's the net book value of Name Insurance? So here I will take you to the financial statement of this company. So this is Name Insurance. So let's go to the income statement. Okay, so this is the income statement of Name Insurance. Now, can you see the key terms that I just explained? Gross premium. This is net increase on earned income. You can see gross premium earned, reinsurance expenses, net premium earned. So if you want to understand the business of insurance, these are the key terms you need to start with. Now I already explained what each of these is. You can see that at the end of the day, this is what their net premium. This is their gross premium, total amount they collected. This is net increase or decrease in unearned income. Now, when it's positive like this, it means that their unearned income is decreasing. That's why increase is in brackets. So if unearned income decreases, it becomes earned income. Go back to the example. 120,000 was collected as premium, 90,000 is unearned, 30,000 is earned, which is 3 months. By the time it gets to the fifth month, what happened? Unearned income will reduce to 50,000. Earned income will reduce to 50,000 because the premium paid per month is 10,000 naira. So a decrease in unearned income is positive for the company. That's why you see 4 point this times this, because it has added to their earned income. You can see. So as this unearned income decreases, earned income increases. So you can see gross premium earned is 5.3 compared to previous year. This is fourth quarter 2021. So let's look at the year. Okay, this is 26.7 against 21. On the quarterly basis is 5.3 compared to 6 million. Then what is reinsurance expenses? I already explained this to 1.2, 1.2. Now, this is the actual amount. So this is now net premium income. This is what they own. This is their own money. This is their own money. So you can see the fees and commission is also additional fee. Additional fee. So you can see the three now. It's now three revenue channel here. Net premium income, fees and commission, and then you can see investment income. So you can see these are extraordinary activities here. So, but the core business itself of insurance, this is where it ends, which is underwriting income. You can see underwriting income. That's the total income earned so far. And then if you now look at the profit from that insurance company, you can see this underwriting profit. Now, out of this amount collected, claim expenses. This is what they paid out. This is what they paid out in Q4, 1.194 million. You can see here. Now, when claim expenses, you can see as it is here, when claim expenses is positive, recovered. That's the amount recovered. Now, how does it work? I paid you 1 million naira for the loss incurred. I took over the property. And out of that 1 million, I'm able to recover certain amount of money. Let's say, if I set up asset as crap, okay, let's use car. the car got damaged and the insurance company paid you 1 million naira, and they took over the car and they're able to sell back that car for 200,000 naira scrap value. So if you have to calculate the claim expenses, it's not going to be 1 million, it's going to be 800,000 naira. So which is 1 million minus the 200,000 recovered. So that's so here they're saying that it's positive. So 1.8. So in 2021, they paid out 6 million as claim expenses, and here they paid out the same amount, 6 million. Then underwriting expenses total is 8.2. So going by our calculation, is the business of this insurance profitable? Let's now do our calculation. Claim expenses is 6 million and 58,917. 6,058,917 plus 6,054,469. That's what? 12, 1, 2, 3, 1. That's 12.1 billion. 12.1 billion. So when you combine the claim expenses and underwriting expenses, what's the net premium earned? So 12.1 billion, 12.1 minus what's the net premium earned? Net premium earned is 19. Sorry, this is not 6 point. I think I made a mistake. It's 6,058,917 plus 8,276,677. So that's 14.3. 14.3 minus what's the net premium earned? You can see here 19.4. 19.4. Can you see? So if you have to do your calculation, we will say 14.3 divided by 19.4. So what's our combined ratio? 0.73. Is this company profitable? Yes. Like I said, the rule is what? Combined ratio must be less than 1. You can see here, combined ratio less than 1 is good, but if it's more than 1 is bad. So from this count, is combined ratio less than 1? Yes. What's the combined ratio? 0.73. So NEM's combined ratio is 0.73. 0.73. So you can even do a comparative analysis of this combined ratio by comparing with the previous year. So let's compare 6 million and 54,469. 6 million and 54,469 plus 4,959,734. 4,959,734. That's 11 million. So 11 million divided by what's the 15.8, 0.69. So previous 0.69, current. So but the most important thing is that the combined ratio is still less than 1. So I'm sure you can calculate the return on equity and net book value. So return on equity will be profit after tax, which is 4.3 divided by total equity of 22.8. So 4.3 divided by 22.8, that's 18.8. So name 18.8. This is it. So if we go back again, net book value, total assets minus total liability, which is this. So that will be 22.8 divided by number of ordinary share. Let's see if we can find number of ordinary shares here. 2.8 divided by 5, 4.56. 4.56. So name insurance 4.56. So what's the price of name insurance? So name insurance is selling for 3.95. So the 4.56, that's the net book value per share. But the company is selling for 3.95. So which means it's undervalued. So 4.56 is around this region. 4.56 should be around, so which is close to its resistance. So let me quickly share some technical setup on name insurance. Now look at name insurance on charts right here. You can see the resistance 3.51, support. I'm sure you would have watched my video on key level, so this shouldn't be strange to you. You can see how it moved to a new high of around 5.38. 5.38. So I think investors saw that the company is overvalued at this point. That's why it dipped to this previous support level right here. You can see. So if NEM is able to deliver good numbers and next book value pushed higher, so it's likely that the company could go up. But from this analysis that I share with you now, you can see that NEM is a profitable insurance company. Combined ratio less than 1, return on equity 18.8, net book value 4.56. So let's look at another company like Ico Insurance. So let's look at Ico Insurance. Okay, so this is Ico Insurance. So gross premium, gross premium income, net premium, claim expenses. So I'm sure you understand this. So let's look at the combined ratio. So we're going to add 39.3 plus, sorry, I have underwriting expenses. What do I have? Let me go back to the detailed financial statement, please. Okay, detailed financial statement. All right, fine. So net premium income is this 15.6. So what's the claim expenses? So that's, you can see what I shared to claim expenses recover from insurer. So the insurance too can also pay claim to you. So you can see 9.6, 9.6 plus underwriting expenses of 16.5. So 16.5 plus 9.6. That'll give you 26.1. 26.1 divided by what's the net premium income here? Net premium income is 15.6. You can see 15.6. So come back here. 15.6. 1.67. So combined ratio of name insurance is 1.67. 1.67. So it's higher than 1. Then let's look at return on equity, which is profit after tax. Profit after tax is 1.7. You can see here 1.7 divided by shareholders equity. 1.7 divided by 37.4. 1.7 divided by 37.4. That's 4.5. 4.5. Return on equity is 4.5%. What's net book value? So we're going to do 37.4. Let's increase this to make it more visible. Seven point four. So it's 32.4 divided by let me see something. Trying to get 'Kay, sorry, I was just looking for the ordinary shares on this statement. 15.6 to 15.6. That's a 1, 2, 3. 15.6 billion. 37.4, 15.6 divided by 15.6. That's 2.39. 'Kay, so let's go back to Ico. I think I made a mistake on Ico. Sorry, on net.